Everyone, it's a very interesting topic today, like passive and active fund. Active is when you try to outperform something. Passive is when you go with the flow. Active is when you try to outperform the market, trying to take advantage of mispricing, incorrectness. And passive is when you don't try to beat the market. Active versus passive, which is, a big debate. How does all this began? The debate between passive and active. There's a very famous hypothesis known as the EMH, or the efficient market hypothesis. Is basically a concept in finance that tell the finance markets are totally efficient and the price of assets fully reflect all available information, meaning where the price of the asset, where this real estate, where this equity is perfectly priced, whatever is available in the market, according to that information, the price, what is in front of you is perfect. That's what this market says. It's basically divided into majorly three parts. First is a weak part, semi-strong. Stock prices reflect all publicly available information, meaning fundamental analysis will not consistently produce excess returns. Here, the question of active starts coming in. So the role becomes how to outperform. So mispricing are available since markets are not completely efficient. There's just a theoretical explanation. I'll be getting into much simpler words also. Such inefficiency in the market can be exploited by using research, analysis, and timing to find mispriced security and generate alpha. When I say alpha, it basically means, suppose somebody says, I'm going to give you a return of benchmarking is 10%. I'm going to give you an alpha of 2 and he gives you an alpha of 3. That means instead of 10%, the consistent fund manager gave you 13%. Suppose you gave the benchmark return is 10% and the alpha was -2. That means the benchmark gave 10% and the corresponding fund manager or the scheme gave you a return of 8%. The excess return over the anticipated return over and above the benchmark is your alpha. Strong. When you say weak, what does that mean? Stock prices reflect all the past market data. So technical analysis is ineffective. They basically don't take any technical analysis, charting, etc. into consideration. Semi-strong stock prices reflect all publicly available information, meaning fundamental analysis will not consistently produce excess returns. Such inefficiency in the market can be exploited by using research, analysis, and timing to find missed price security and generate alpha. Stock prices reflect all information, both public and private. That meaning no one can consistently achieve superior returns. What is there? You will get that only. So markets are completely efficient and it is futile to try beating the market. Let's look at the similarities first. In terms of flexibility, any investment fund can employ active or passive investment. Second, structure to use pool money from investors to buy and sell investment. Securities to be held in the fund and share returns generated. Simple. The way any mutual fund functions, whether it's passive or it is active. Third, certain similarities, benefits such as diversification and professional management. Both are managed by fund managers. Can share the same investment objectives such as growth, income. Like example, they can share the same thing. My scheme basically wants to generate a growth, or they want to protect the capital. It can happen both in the passive investment and the active investment also. Risk is involved in both. A major difference is in the management style. How the funder invests and manages. Actively managed fund because you consistently try to outperform the corresponding benchmark. So you buy and sell to generate an extra alpha. So your cost might go up. The cost because of STD, the other taxation, they might go up. So you have a higher expense. Active funds have higher tax liabilities than the passive fund because of frequent trading, buying and selling. So you outperform the benchmark. That's the whole idea. Active funds generally attempt to outperform a market index, whereas passive funds try to match the performance. In an active fund management, you need a fund manager. A fund manager role becomes very, very important. But in a passive fund, basically the role of the fund manager is very limited. He's simply replicating a particular index which is already there. So concept of a fund manager becomes more important in an active fund than a passive fund. That's the basic difference of the two.